Hey everyone, John and Ray here, slingshotfutures.com. Today we're going to be talking about market edges and zones of interest. Now, this is something that a lot of traders just kind of overlook. It's something that it's so easy to get lost in the smaller picture, on the really zoomed in picture, that you kind of forget about where the major edges are. So what we're talking about is actually something that we utilize today in the room in locating an area of interest in where we want to begin a trade or find just an area of interest. Now, what I'm talking about is when we're looking at the market, when we're looking zoomed in like this, right, or even on a 5-minute chart or a tick chart that's really, really zoomed in, it's hard to lose sight of where everything is taking place, where all the big stuff is happening, where all the big players are interested, the ones that move the markets. So to kind of reacquaint ourselves with some of these areas, sometimes it's a good idea just to zoom on out. Now, when we're looking at this overall move, what are we looking for? Well, first off, we have to have a general understanding of what I mean by market edges. I don't mean an edge like the probabilities in my favor. That is an edge as well, and that's what we're looking to do by finding these edges. But what I mean are edges of market structure, right? Areas where the market is prone to be predominantly buying or predominantly selling. So one thing that we've been talking about for a long time now, since really kind of the beginning of January, is how massively overbought the S&P is. Now, if you know me, you don't hear me say overbought very often because that scenario is just not something the markets really care about. If it's overbought, it doesn't matter. It can just keep going. But what we're talking about here is how strong of a lift up we've had on the S&P. Now, when you have this type of rally where it's a really strong leg up, barely any pullback, strong leg up, barely any pullback, strong leg up, pullback getting a little bigger, but still not very much, and then continuing up. But you'll notice it starts getting a little bit wider. We start seeing these wider pullbacks, bigger moves, wider pullbacks. It's lost its steam to the upside. Now, that doesn't mean by any means that the buyers are done. But what it does mean is that the market is beginning to transition, right? If you look at a standard market transitional phase, you have an accumulation phase, right? And then you have a distribution phase, accumulation phase, distribution phase. It could be up, down, whatever, but there are these decision points that are being made. And these decision points are where the market is, well, it's kind of in the name, making a decision. Does the market want to go up or does it want to go down? Now, what we're looking at is playing these off of the edges of those highs or lows, coming at it from a bias. So what I mean by that is when we're rallying up aggressively like this, I'm not interested in selling, right? That's way too much bullish strength for me to want to sell into. Instead, it makes a lot more sense to wait as a seller until we begin a transitional phase, right? Why would I want to sell when the market's raging higher like this? It makes a lot more sense to wait for the market to kind of round itself out and then look for a possible sell. So if I'm looking to sell, where do I want to sell? I don't want to sell down here hoping that it goes lower. That doesn't make any sense. What we just learned, what we just talked about, is the market goes up, transitional phase, makes a decision point, and then from there goes down. So if the market in this case is going to go down, where do I want to sell? I don't want to sell way down here. I want to sell up here with the intention of there being more sellers up here. We know the buyers have lost their steam to the upside. We've seen one of the largest pullbacks that we've had on the S&P for a while. When we go back up to the highs, what's more likely to happen here? Right? We have buyers who are coming in on this pullback. They maybe bought the swing low, or maybe they bought the previous major swing, or whatever reason they bought in. Irrelevant. What we're looking for is, where are they going to get out? Right? Where are the buyers likely to start taking profit? Well, what better place than the highs? In this case, we actually have a spike and channel type formation, so what better place than the highs of the spike and channel? And then it starts pulling back again. This is giving us an idea that, well, wait a minute, if this market is going to keep going higher, why is it failing so many times? We've had a really, really strong rally, the first good pullback, second move up, now it's not doing as well, now it's probably going to be a turning point up here. So what we're looking for is being a little bit contrarian. Now, there are a few other levels. Not only are we at the high of the spike and channel, we're also at major swing highs, which generally in this type of structure is going to get weaker and weaker. So even if it does go above the high, probably not going to be by that much. And along with that, massive structural resistance off of 3,300, big psychological level. So when we have all of those things stacking up, I'm looking for a sellable opportunity to push the market back down again. Now, I don't necessarily mean, well, there it is, drop a limit order, we're going to go, let's go, right? It's not that simple. We need to wait for exactly what we're waiting for right here, a transitional phase. Let the market show you that it actually wants to start turning. Don't just jump in. Let the other people do the hard work, right? Now, what I mean by that is we're going to come in here, right, and we're going to look at this area underneath a little bit of a microscope. So let's set this to all charts so that we can see it everywhere. And apparently I turned off all of those. Let me turn those back on. And we're going to zoom in a little bit here. So now let's go into a 1 minute chart. Now from a 1 minute chart perspective, I don't care about what each candle is doing. What each candle is doing is totally irrelevant. It's worse. A 1 minute candle versus a 60-minute candle is so far detached that it doesn't matter. What we're looking for are those transitional phases, right? So the market's raging up, right? This is not a decision point. A decision has already been made, right? The market wouldn't be moving like this if a decision hadn't been made. What we're waiting for is the same thing that we just saw on the 60-minute chart. Massive rally to the upside. Now it's starting to get a little bit weaker. Guess what I'm going to do when it comes back to that third time? That third time, we know in the 60-minute chart, right? This is a 60-minute level of resistance. Now we're seeing the exact same market structure on a 1 minute chart zoomed out. I'm going to be looking to sell those edges with the anticipation that we're going to have the market roll over and come back down to some of the previous areas of interest, right? Now, some of the previous areas of interest, we have to be logical here. It's not, I mean, don't get me wrong, I'd love to see it go all the way down here, and it did eventually, but realistically, if I'm selling here, I'm looking to take initial targets somewhere inside of here, because it appears as though that's where a decision has been made before, right? So when the market comes off of these highs, we're looking to execute some form of a selling opportunity. Now, if you're really aggressive, there could just be a sell right at the highs. You could play options. You could play maybe a TSS pattern short. You could be playing a breakout pullback. You could be playing a wedge breakout. However you want to get in, it doesn't matter. What we know is that we're stacking the edges, and I'm talking probability this time, in our favor on top of a market edge, an extreme, right? We have the accumulation phase, distribution phase, accumulation phase. They're making a decision. Now they're starting to break down. Now, the reason why it's so important to try to sell as high as possible in this move is because my risk reward is so much better, right? If I'm selling way down here, guess what? My stop still has to go way up here. Or if I'm building into trades, I still have that open risk way up there. I'm much better off looking at this from the perspective of, well, if I want to sell up here, realistically, if I were to look back at this in hindsight, if the market went way up here, I'm probably wrong. What does that mean? Well, that means that I can sell here with my intentive stop right here, but guess what? My target, my first target's way down here. Just my first target is easily a 2-to-1, maybe a little bit more. Then my secondary target, back down to some of these other previous levels where decisions have been made, right? That's what, another 4-to-1? Sorry for the bell. This is what I'm talking about, right? We're stacking our edges. We're looking at the edge on the 60-minute chart, and then we're waiting for markets to give us structure, to give us a clue that we should be doing the same thing in the same direction. The 60-minute chart is overextended to the upside and forming an exhaustion pattern, right? Starting to kind of peter out. So I'm looking to sell there. We zoom into the microscopic view, and this is what we get. The exact same market structure. So I'm looking to sell the highs with a stop just above the highs, because realistically, if it goes that far, I'm wrong, right? There's no questioning that. But if I'm right, look how much reward I have. And that's just the first target. If you're trading multiples or options, which are significantly cheaper and allows you to trade even more, then you have a huge edge. Not only are you taking your first target at 2-to-1, but you're also going even further and saying, well, hey, you know, if I get 2-to-1, maybe I'll take some off, but I've got a shot at potentially 5, 6, 7, 8-to-1, and we still haven't even left a 1 minute chart. If this is truly a successful pattern and it really takes off, you can jump back to something like the 60-minute chart and say, well, wait a minute, you know, if I'm short from way up here, I've got a chance that it goes all the way down here, or maybe even all the way down here, or even better yet, if it breaks through that, maybe even all the way down here, risking what, 4 or 5 points for a potential. Now it's a potential, this is a big potential because we're talking a 1 minute chart, but if it does take off, you could have a 1 contract runner, a singular option runner, maybe some spider options, whatever, for a huge move. But we didn't know to do that until we started stacking those odds in our favor. Looking at these market edges can give you a huge clue in terms of what to expect, right? So very simple, right? It's not something that takes a huge amount of effort. Just look at the markets, right? This was obviously a decision point. Something happened here. So if the market returns back down into this area, I'm not just going to blindly buy it. But what I am going to do is zoom into a faster time frame and see, do the buyers want to show that they are coming in? And if they are, I want to buy as low as possible into that move, knowing that if realistically it gets down to this far, I'm wrong. But if it does go in my favor, I've got the potential to go all the way up here for 2 to 1. And that's just the first target again, right? Then the next decision point, maybe at a 4 to 1, and then the next decision point back to all-time highs. So it's very important to be keeping an eye on these major market edges and look to try to find a way to get a lot of things stacking up in the same place. If you can get a Fibonacci level on top of a market edge with, the bottom of a channel, and it's also a standard deviation down, and it's a maximum ATR, whatever your thing is, when you can get them to all line up in the same place, it gives you a huge edge in terms of probability on where a high probability area is to start looking for trades. Doesn't mean you're going to be right. We all know how the markets work. But what it does mean is that we have all of the things in our favor to allow us the potential to be right. And if we are right, the reward is 2, 3, 6, 10 times larger than the risk. That's the kind of trade that I like sinking my teeth into. So that's what we're talking about when we're looking at market edges and just kind of finding those zones of interest. Zoom out, right? I know it's really, really easy to get lost in these minuscule movements of candle to candle to candle. And I fall victim to that all the time too. But realistically, if I'm looking for an area of interest, what better place than, let's say, right here, right? That looks like a great spot. If I'm going to be a buyer here, I know that I can buy here, and my stop doesn't have to go very far, but my reward is going to be all the way up here. Look at the risk reward, right? It fits in perfectly with exactly what you're looking to do. Something to keep in mind when you're approaching your trade plans. Zoom out to those larger time frames, and I don't just mean zoom out like looking at a 60-minute chart. I mean literally zoom out, right? Grab the scroll bar and just crank that thing to the right and look, right? Where is the consolidation? Where are these decision points, right? There's a decision point there. When the market came back, it's no surprise that it had a response, right? Those are the types of things that we're looking for when we're trying to find the highest probability in terms of edges to give us our best bet at a good trade. Especially in these types of situations, a best bet at a good run too. So that's going to do it for this one. Hopefully you find it useful. Hopefully you find it interesting, and maybe something you can add to your tool belt if you're not already doing it. Something to keep in mind. That's going to do it for this one, as per the usual. I hope you had a great day of trading. I hope you had a fantastic week of trading whenever you're watching this. If you have any questions, shoot me an email, jbrink@slingshotfutures.com. Till the next one, we'll talk to you all then.